we have Jason Matthews with Matthews Financial Insurance Solutions. And Jason's going to be answering some questions for us. Should you pay off your student loans to save for retirement? How does your student loans affect your purchasing a home? And how does your retirement plan help you purchase a home? These are some questions we have for Jason. Jason, thanks for coming.
Definitely, Jeff. I'm excited to be here.
All right, and before we get started, I want to say congratulations on the new book, too.
Thanks, appreciate it.
So give us a little something about this new book you got coming out.
New book coming out soon. It's called The Age of Self-Reliance. It's helping people prepare for our new economic system. And if you look at it, I think the biggest issue in the world for economics is the aging population. And the question is how you deal with that, how you properly plan, and how you properly plan for retirement, savings, and making sure you take care of yourself and your family down the road where you might not be able to have Social Security or pensions down the road.
All right, we're looking forward to seeing that book when it comes out. Now let's jump right into these questions. First question, should you pay off your student loans or save for retirement?
Thanks, Jeff. I'm glad you asked that. I get this question all the time, especially with my younger clients who graduated, went to school, who's doing well. And I always tell them it's a combination of both. One thing, with student loans, you can get a tax deduction if you make 80 grand or less, or if you're a couple 160. And you can deduct $2,500 of the student loan interest off of it. So it's a great way for them to get a tax deduction, especially for oftentimes you might be younger, might not have kids here or own a home. This is a great deduction that they normally wouldn't have. But at the same time, if you're going to retirement, you have an employer. A lot of employers match your match your retirement account. So, like for instance, you have a 401k plan, 403b, a 457, whatever you want to call it. One of those numbers. Oftentimes, your employer might say, "Hey, we match 3% of your income if you put in 3%." So, for instance, you make $100 grand a year. You put $3,000 into it. They put $3,000 into it. You got $6,000 for your retirement. Why? Because you took that 3%. Bonus that pretty much they gave you, that free money.
Right.
So I always say you want to take advantage of that, but at the same time you want to take advantage of that tax deduction we do have.
All right. Here we go with the second question. How does student loans affect your purchasing a home?
That's a great question. I get this question a lot. I don't do mortgages, but I see what the impact of a lot of things happen.
Right.
One thing is that oftentimes there's a huge population, I want to say about 40% of student loans, who are actually on deferment, which means that people are not paying their student loans. It's not hurting their credit, but it's prolonging that period. And most mortgage companies want to see you on some type of payment plan with your student loans to qualify for a mortgage.
Okay.
So that's one way they do. So usually you have to put yourself on a payment plan. But the second way it affects you is there's a lot of people might have 100, 200, 300,000 in student loans. And the problem with student loans, it kind of hurts on how much of a home you could qualify for. So let's say you usually qualify without the student loans for an $800,000 home. But now you have $300,000 worth of student loan debt. So instead of getting that $800,000 home you thought you could qualify for, now it'll put you in a $500,000 home. So you qualify for less home based off on how much student loans you do have.
$500,000, that's not bad for a home though.
Right, not bad.
So, yeah. Last question. How does your retirement plan help you purchase a home?
Great. So we talked about how a lot of employers, they match your retirement plan, which is great, which is free money. But the good thing is, with those plans that your employer matches, if that money is still in your 401k plan, is you can borrow that money, 50% of it up to $50,000. Usually. Always ask your plan administrator for that.
Right.
So let's say you had 100 grand in, you could borrow 50,000 out of that. So we have 50,000 for our down payment. Let's say we have an individual retirement account or a Roth IRA. If we're a first-time home buyer, remember, that's somebody who hasn't bought a home in the last 3 years, a first-time home buyer.
Right.
That's what the government standards is.
Okay.
We could pull out $10,000 out of our Roth IRA and then a $10,000 out of our individual retirement account. Now, without any penalties. But with the individual retirement account, we still have to pay taxes on that money. Right. So let's say you're in a 20% tax bracket. I pull out 10, so I have 8. I did the match of the $50,000 from the borrowing from my employer plan.
Right.
I got the 8 from the IRA, and I got the 10 from the Roth IRA.
Right.
That's right there, 68 grand we can have up to for our first home, for our purchase of our down payment for our home, which is a huge perk.
Wow, that was some great information. So thanks, Jay, for coming.
Definitely.
We're going to have you back. I know we're going to get some questions. Now, if you got some questions, you want some follow-up information, just contact Jay. His information is below. You can also contact me. My information is also below. Thanks for watching. We'll see you next time.
Thank you.